What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked number one on Wall Street in the 2024 All-America Institutional Research Survey. In this week's episode, I wanted to share an excerpt from a recent in-depth discussion with Adam Taggart, the founder of Thoughtful Money. In this segment, we'll discuss the bifurcated macro and market backdrop and what my HOPE framework suggests about the market outlook in 2025. If you'd like to listen to the full-length interview, which includes video and a handful of supporting charts, click the link in the show notes to Adam's Thoughtful Money YouTube page.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest is best known for his HOPE framework, a highly effective way to measure the health of the economy and to tell whether it's getting stronger or weaker. As we begin a new year with record housing and affordability, trade wars, and a cooling jobs market, what does this framework tell us is in store for 2025? To find out, we've got the good fortune to speak today with Michael Kantrowitz, Chief Investment Strategist and Managing Director at Piper Sandler. He's also recently launched a new podcast titled What's Next for Markets. Michael, it's great to see you again. Thanks so much for joining us today.
Good to see you, Adam, and thanks again for having me on.
Hey, it's always a pleasure, my friend. Look, I've been having a lot of people really the past couple months say, get Kantrowitz on. Got to find out what's going on with the HOPE framework, especially as we're coming into this new year. The new year is categorized by, super high valuations in stocks, at least. A lot of change and uncertainty with the new administration. I mentioned in the intro here, record housing and affordability. Trump is sending 3 to 10 curveballs out a day, that spinning heads about what might happen with the economy, with tariffs, et cetera. And the jobs market, Jerome Powell would say it's been normalizing. Some other people would say it's cooling. I know these are all factors that go into your HOPE framework. So super excited to get the latest update on what your framework is telling us. Real quickly, before we get to that, if we can just kick things off with the general question I'd like to ask you at the start here. What's your current assessment of the global economy and financial markets?
I think the global economy still remains uncertain, given all those things you just mentioned. But certainly in many of the developed economies, I think we're starting to see some stabilization in pockets that have been weak for the last several years, most visibly in the United States. And I think between the outcome of the election, the Fed cutting rates 100 basis points, there's some sense of renewed optimism. And when we look at the global backdrop or the US backdrop, I would say that we've been in a very bifurcated macro economy and bifurcated market backdrop for the last several years. And I think that in 2025, the weak part of that bifurcation will hopefully start to heal somewhat and improve, and that we should see somewhat better breadth around the global economy and certainly within the US economy, and unlikely to see a market that's just led by 7 stocks this year.
Okay, so I want to give you kudos that you have this term of bifurcation. You've been beating that drum for a good while. I think that really has been a very major theme. I think it's in many ways a theme that perhaps carried Trump into office with the majority of the popular vote that he had, because the bottom part of the K in this K-shaped recovery or bifurcated recovery we've been having, there's a lot of anger and frustration in that bottom part of the K, which I think we could maybe safely say is 80 to 90%, sadly, of the public. So what makes you think that the weak part of that bifurcation is going to start improving this year? What's giving you optimism there?
When thinking of catalysts, I always start off with what was the catalyst to make those weak parts of the economy weak? And therefore understand, okay, this was the problem, and then ask ourselves, is that problem starting to resolve itself? So I think when the last couple of years, there's been a lot of debates around whether the economy is rate sensitive or not. And the Fed's rate tightening cycle certainly slowed many parts of the economy down a lot, but didn't really have a very clear negative impact on the broad economy.
Mm-hmm.
But I think, again, that's the difference between looking at something like GDP overall or the S&P 500 overall versus looking at underneath the surface of the parts. So everyone knows the market's been very bifurcated, and the Mag 7 have been leading the charge, and that's largely been because earnings growth outside of the Mag 7 have been quite weak. And then when we look from a macro perspective, the services part of the U.S. economy has been holding things up while the manufacturing part of our economy has been in contraction for the last 2 years or so. And we also saw similar type of weakness in small business activity and small cap earnings. We've had 3 years of consecutive declines in earnings. So why has that been the case? I think, yeah, the Fed raised rates pretty sharply, price levels picked up, and essentially those companies, consumers that were paying higher interest expense really bore the brunt of that. And those companies and consumers that didn't have as much, let's say, operating leverage or economies of scale similarly paid the price of that. Now we have the 100 basis points lower Fed funds rate. Commodity prices have been fairly weak. The market's up a lot. Home prices are up a lot. And so I think those parts of the economy that struggled from the Fed tightening will in kind start to improve from the 100 basis points of rate cuts we've seen.
Okay. And is it just the rate cuts on the short end of the curve, or is part of your optimism based in an expectation that longer term yields may start coming down this year as well?
It's more the short end. And if you think about which parts of our economy are more impacted by the long end, that's really housing. We go out beyond 10 years of duration. Whereas if you were to ask me why the Fed cut, and I would simply point to small businesses. The Fed didn't cut because the S&P 500 was weak or GDP was weak. They cut because the lower end of the consumer in terms of income has been struggling, and smaller businesses have been struggling, and they essentially pay, in terms of lending, they borrow at usually interest rates that are derived from the Fed funds rate or the prime rate. So whether it's credit cards, HELOC loans, business loans, small mom and pop shops, they borrow from their local bank, which again, usually will set that on prime plus. So 100 basis points lower, the help or the tailwind from that is going to be really geared towards them. I don't really think the 10 years got a whole way to go lower. I think we're going to be bouncing around 4 and 5% on the 10 year for the foreseeable future. What could break us down below that range? A sharp rise in unemployment. I think we're starting to see the labor market normalize and firm up. What could push us above 5%? Obviously, another inflation shock, perhaps, however it came about. But I think the odds of that are also quite low. And so I think we're going to be bouncing back between those levels. Also, banks have eased lending standards over the last year as well. So that's another less followed data set that comes from the Fed's senior loan officer survey. So I'd say a combination of that plus commodity prices have been low, energy prices have been quite low, gasoline's been low. So I think at the margin, we've got more easing in the pipeline than we've had really since COVID.
All right, Michael, look, lots of questions from what you just mentioned there. But as you said earlier, you're the kind of guy who likes to roll up your sleeves, look under the hood. That's what the H.O.P.E framework is really helpful in helping us do. So we'll walk through what your H.O.P.E framework is telling you in just a second here. Let me ask you this. So if I heard you correctly, you think that one of the things that's going to provide relief this year is the fact that the Fed has started lowering interest rates. Get a sense for you in a little bit if you think they're going to be able to continue lowering them throughout the rest of the year as well. But what's interesting is one of the things that seems to have had a lot of explanatory power, at least a lot of the folks I interview say, has been liquidity has been net positive over the past 2 years. It's one of the things that really kept us out of recession when everybody thought we were going to fall into recession starting in 2023. And the narrative is the Fed's been in this tightening regime. They've been hiking interest rates. They've been doing QT. Therefore, the Fed is draining the pond. First off, regardless of what the Fed was doing, on the fiscal side, we've been filling the pond, lots of liquidity there. But even on the Fed side, there have been things like the draining of the reverse repo program, right? The creation of the BTFP. So things that actually were liquidity stimulus, and I'm not saying you have to agree with them, but certain analysts, Michael Howell being one of them, who has his own measure of all this, believes that certainly collectively, Fed and fiscal policy have been net positive. But even on the Fed side, he thinks it's largely been net positive despite the tightening and the QT. So where I'm going with this is here in 2025, we've got perhaps a change in policy on the Fed side. The reverse repo program facility is pretty much empty at this point, but we also have a massive refinancing wall of debt, both on the government side, but also in corporate America side. And yes, the Fed has brought rates down 100 basis points, but right now it looks like corporate debt's going to re-rate at a substantially higher amount than these companies right now are sitting on really cheap debt they took out several years ago. That all acts like a liquidity sponge. So I guess my question to you is, do you have any concerns about the shifting liquidity environment and the fact that it could actually create some economic headwinds here as liquidity starts at least not growing as fast as it was, or maybe even receding?
Yeah. So I do expect interest rates, again, to stay between 4 and 5%. And I do anticipate that the Fed's probably done. Again, maybe we've got one cut left, really coming from a good inflation data point, but I think the Fed's essentially done. I think we can just look at interest rates and see how interest rates have been pretty strongly negatively correlated with equities, particularly over the last 3 or 4 months. And I would argue that if rates stay above 4.5% and rise, that's going to be a big headwind for equities, particularly pushing multiples lower. So I don't think we need a whole lot of tightening or rates have to go up a whole lot, because if you look at where credit spreads are, look where market multiples are, they're still kind of priced for a backdrop that suggests rates are going to fall a great deal further. And if rates stay where they are on the 10-year yield, and if the Fed is indeed done, then I think we'll slowly see multiples grind down. And obviously, if inflation or growth more rapidly accelerates, then rates are moving higher. And I think that's going to squeeze the bottom of the K. So yeah, the small caps are not out of the woods yet. Nobody's moving in residential real estate world. It's becoming more regional. Total home sales are still below 5 million. Commercial real estate still has refi risks. So by no means are we out of this problem that is still largely ahead of us in terms of rising interest expense and rising debt costs and the problems we're seeing in the housing sector.
What I'm hearing from you, Michael, is a sense of the fact that the performance of the financial markets this year, at least stocks, is not going to be as euphoric as the past 2 years have been. That we're probably not likely to see another 20+% up year.
Yeah, and I think, again, keeping it really simple, market's not really pricing any risk. And you could argue and say, well, you disagree with me, and that's fine. But when you look at credit spreads at 25-year lows and large caps near 20+ year highs in terms of valuations, and even small caps, they were trading at 11 times earnings in 2022 at the lows. And now the S&P 600 is trading somewhere near 16 times forward earnings. Yeah, that's less than large cap, but I think appropriately so, because the small cap index is more cyclical and lower quality. So from my lens, there's not a lot of risk priced into markets. And what that means, at best, multiples could stay high, but are going to be a lot more volatile going forward, because you don't have this problem everyone's focused on that could just grind away over the next 9-12 months. Maybe tariffs don't happen, but again, we're near still all-time highs on markets. And so it's hard to argue that tariffs have had a huge negative impact on equities that could provide some relief if it goes away.
So I've now mentioned your HOPE framework several times. Michael, could you just give a overview of what the HOPE framework is for the few folks watching that haven't watched before and may not know that it's an acronym and that it stands for several different important components of the economy?
All right, Adam. So the HOPE framework, it's an acronym. It stands for Housing, Orders, Profits, Employment. This is based on quantitative data. It's looking at business cycles going back to the 60s, and the impact of each one of these pieces of macro data reacts to changes in Fed policy, changes in interest rates. So you see housing, obviously a very rate sensitive sector that often reacts pretty quickly in terms of when mortgage rates change, which is then followed by orders. So that more broadly speaks to leading indicators of the economy, like the ISM index, the PMIs, consumer new orders. And then those leading indicators then spill over into coincident indicators, which I would say profits, industrial production, capital goods orders, and then that's followed by employment. So it's the supply chain of the macroeconomy. And we use it as just a simple way to think about what these major milestone points of the economy are doing, as it helps us to understand when the Fed is easing or when they're tightening, what may follow that. And the having these checkpoints along the way helps us to gauge probabilities a little better, whether or not the economy is going to broadly improve or be more bifurcated or go into recession. And so the most recent HOPE cycle, beginning really in 2022, was that we had a Fed tightening cycle. Housing collapsed in 2022. And when I talk about housing, I mean activity. So building permits, mortgage applications, housing starts, new home sales. And then that was followed by in 2022, all the manufacturing PMIs were at near record levels, collapsed over the next year and change. Profit growth slowed, of course, in 23 into 24. Particularly if you take out the Mag 7, profit growth was pretty much zero those 2 years. Obviously, the Mag 7 contributed to a lot of profit growth, but that's ultimately why those stocks drove the market. And then employment, we certainly haven't gone into recession, but employment did certainly soften, weaken. There were parts of the employment backdrop that were much weaker than others. But again, the economy, the result of the Fed tightening cycle led more to a bifurcation than a broad-based decline in the economy. So that's where we've been. If I think about it today, I'd say housing has been is somewhat of an L-shaped bottoming. I want to call it L-shaped recovery, but L-shaped recovery seems like an oxymoron. So it's really been more of this kind of big decline in 2022, and it's just been zigzagging over the last few years. And that reflects the affordability crisis we currently have in most of the nation. PMIs or orders, again, those tanked in 22, but are actually back into expansion territory for the first time in several years. Profit margins are starting to, and earnings revisions breadth are starting to broaden out a little bit. We're actually, for the first time in 2-3 years, seeing small cap forward earnings estimates start to improve, and same thing for mid caps. And then, as I said earlier, employment, the unemployment rate did go up from 3 and change to about 4.3%. And it remained low enough to obviously not broadly hurt the economy, but it did follow the sequence. The tough part about any macro analysis is getting the direction is probably more than half the battle. And then getting the magnitude on top of the direction, that's really the cherry on top of the sundae. And my HOPE framework is more directional and looking for inflection points. Magnitude is really hard to model because cycles can be so different. How could we have modeled the fiscal impulse for the last couple of years? We knew it was positive, but did we know how positive that element would have been? So again, a lot of reasons the employment backdrop didn't more broadly or more sharply deteriorate. And as we sit here today, I think the worst is behind us from at least the parts that weakened from the tightening cycle. I would expect unemployment to trend sideways here, plateau at these levels, roughly around 4.1, 4.2%. I'd be surprised if we fell real sharp. And I also think that would potentially lift bond yields higher than where they are now, which could be problematic. So that's the overall summary, and we can dive into any one of these.
Yeah, let's dive into them all if you can. And I've got so many questions. So I listened to your explanation there, Michael, and to me, it seems that housing is in freeze right now. It's in deep freeze. The L shape, whatever you want to call it, it fell. It's still on the floor. It's still just kind of rolling along the floor.
Yep.
Orders and profits, we could maybe put those in the green shoots category.
Absolutely.
Okay. Unemployment, I would say TBD, although I would, and I'm not the expert you are, it seems like you said you think the worst is over.
You've been listening to my discussion with Adam Taggart from Thoughtful Money. If you'd like to listen to the full-length interview, which includes videos and a handful of supporting charts, follow the link in the show notes to Adam's Thoughtful Money YouTube page. Thanks for listening, and thanks to Adam at Thoughtful Money for the great discussion, and we'll see you next time.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.